This is the Aussie dollar daily chart example that we looked at earlier, where, if you were basically just buying when it touched the Bollinger Bands in the oversold zone, then, you would have had 3 losers and 1 winner. So instead, what we do is we overlay the first standard deviation Bollinger Band. So we overlay the first standard deviation Bollinger Band so that instead of buying here, or buying here, or buying here, we wait for it to come out of the downtrend zone. We would go long here, targeting the Bollinger Band on the other side. Here's just another example over here. We wait for it to close out of the Bollinger Band, targeting the Bollinger Band on the other side. Another example, Eurodollar 1-hour chart. This happened to work really well. This one came outside of the Bollinger Band, targeting the Bollinger Band on the other side. This is the type of price action we see very often because of a news release, because of a market session, because of whatever, where a currency pair can be in trend for a little while. Yes? Very good question. So this gentleman asked, where would you put your stop on this? And the best place to put your stop is usually when the technical indicator is negated, so the signal is negated. That means that if it enters back into the Bollinger Band, uptrend zone, or downtrend zone, that means the signal was negated. So what I would do is I would probably put it at a little bit above the high of the previous candle that came out of the Bollinger Band, in this case. But if it's really large, you got to be a little bit more, flexible with that. But anyway, so it comes out of the Bollinger Band, it touches the Bollinger Band on the other side, it sells off, sells off, sells off. We wait for it to come out of the Bollinger Band, then we go long, targeting the Bollinger Band on the other side. And, you see, different examples here. And this just shows you, kind of a longer term chart. Shows you that, that it also works fairly well in the longer term chart. Comes out of the Bollinger Band here, targets the Bollinger Band on the other side. Rallies, rallies, rallies. Maybe you could have picked a small top here, but, maybe not. Maybe you could have, I don't even know where else you would get in, but maybe you could pick a top here, but I think it's much better to wait for it to show weakness. Then you enter, targeting the Bollinger Band on the other side. So you just see multiple examples of this on a regular chart. Sometimes it doesn't get quite there, and that happens often on a daily chart because these are really big candles that we have. And that's why I always advise you to use a trailing stop, lock in some of those profits because, these gaps between these levels can be maybe 300 pips, sometimes even 400 pips. Hopefully at 100 pips, you already started to move your stop and, kind of trail your stop along the way. And this just shows you another example, kind of scrunched up, but when it comes out, it likes to touch the other side, comes out, likes to touch the other side, and just kind of different examples showing you that when it comes out of the uptrend zone or the downtrend zone, it likes to touch the Bollinger Band on the other side. The third way to use the Bollinger Bands is to use the Bollinger Bands to buy at value. So sometimes the trends can be very strong, right? And when the trends are very strong, you think to yourself, where can I look for an opportunity to get into the trend without chasing the price? Because sometimes it can be very difficult. I mean, it's falling, 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 falling. If you pull the trigger and you buy, you sell here, you don't know if that's going to be the low, you don't know if it's going to retrace, it's just really hard. And so the Bollinger Bands can also help us identify points to enter, to buy or sell at value in the direction of the trend. So I've got a daily chart here. And once again, we have our Bollinger Bands on these charts here. And I've circled, there's a whole bunch of circles here. And basically, the whole idea here is that this is a downtrend, so this is a fairly strong downtrend. And what we want to do is we want to wait for the currency pair to retrace to the first standard deviation Bollinger Band. When it retraces to the first standard deviation Bollinger Band, which is where this blue circle is, that's a point in this downtrend to sell at value. And the upside, when it's rallying, 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 when it retraces, when it dips back to the first standard deviation Bollinger Band, on the upside, those are points to buy at value. So rather than, just kind of selling arbitrarily, because like in this case, it had a huge retrace, you would have stopped out if you try to sell here probably because it's such a big candle. I always think that's better to look for opportunities where it retraces to the first standard deviation Bollinger Band. Now, the question is, where should you put your stop? And so this dotted line here is, if you look, and like I said, this example is in one of the pages here. It's in this example here. But if you were basically going to put your stop, this dotted line is the 15-period simple moving average. And so you can see, for the most part, most of the time, there will be opportunities we get stopped out because no trading strategy works 100% of the time. But for the most part, the 15-period simple moving average is a pretty decent place to put your stop. And so the circles, does everyone understand this? Basically, we're waiting for the retrace. So in the downtrend, we're waiting for a retrace to the first standard deviation Bollinger Band, and then we sell. Any questions at all on this? Same thing with, yes, sir? You have a question? Yes? It's the 15-period. Well, the 15-period moving average, it's a moving average. So if you put the moving average onto your chart and you hover at the 15-period, it'll tell you exactly what that price is. So it's just so basically, if you put the moving average on your chart, you can tell what that price is. Yes. Very good question. What we saw, what's the shortest time period you can use the double Bollinger Bands? In the previous example, when we were doing the picking tops and bottoms, we used it as low as 1 hour. In the retrace, however, we typically use this only on the daily and sometimes on the hourly, but mostly on the daily. And I don't really use it in any of the iterations in between, like the 4 hours, 12 hours, and things like that. But it does, it works best on the daily. We call it we call it the retrace to the Bollinger Band, because it's in the downtrend, so it's selling off, selling off, selling off, and we're waiting for it to retrace to this, and then we get in. Yes? So he asked, can you use the Bollinger Bands to day trade? You can, because you have two options with this. One option is you can take let's say you see this happen, right? You can take a trade that lasts for some time and participate in this trend, or you can trade a small retrace, meaning that you only take maybe 30 or 40 pips. Basically, whenever the candle closes, which is in this case 5 p.m. New York time, you can take it for whatever you want, 30 pips, 40 pips, or something like that, and make it a shorter term trade, which we have done too. Yes? On fx360.com, we do a currency pair in play every day. And I show the Bollinger Bands on my currency pair in play to say whether it's an uptrend or a downtrend. But the currency pair in play is in play because of the amount of data that's coming out the next day. And it's in play because we think it's going to be an active currency pair. And so we're showing you the support and resistance levels because we think the data will trigger a movement. And then we do talk about where it is as in the zone and stuff like that.